Good afternoon, everyone, and welcome to the hopefully very informative and relaxed and enjoyable webinar on the exciting area of M&A and deals, and particularly in 2021. I'd like to very much also welcome our expert panelists today, Adrian, corporate finance partner at FRP Advisory, Paul, head of London M&A at Mazars Deal Advisory, Andrew, managing partner at HMT, and Nick, partner Deal Advisory, Gerald, Edelman. To all those attending, again, thank you very much, and we'd welcome any questions. If you could put those in the chat box, don't email them in, as I believe Zoom asks you to, but do put them in the chat box, and we'll get round to answering as many of those as possible at the towards the end of the webinar. So let's get started. Just going round for brief introductions. Nick, please do introduce yourself and what's happening with you these days.
Yeah, thanks, Mark. Yeah, pleasure to be part of the panel. So as Mark said, I'm a partner at a firm called Gerald Edelman. We're a mid-market, for want of a better word, accounting firm. We don't like referring to ourselves as accountants because it has specific connotations. But yeah, we're a mid-market firm. I head up our department that's called Deal Advisory, which is largely helping clients in the what we call the lower mid-market, looking to either sell their business or raise funds. We do across all different sectors, so we don't have a sector specialism. We try and be, our specialism is obviously in the advice that we give, and at the specific size, which is sort of deal sizes from anything from 2 to sort of 50 million. We've actually seen, we had a very quiet, as I'm sure the other guys have experienced, a very quiet period, sort of March, April, May. But actually since the summer, things have massively ramped up in our world, and we're pretty busy at the moment, and we're hoping to get a couple of completions underway before, in the mad rush before Christmas. But look forward to discussing things further on this chat.
Thanks very much, Nick. And Andrew, please.
Oh, thanks, Martin. Hi, everyone. My name is Andrew Thompson. I'm managing partner of HMT Corporate Finance. We're a mid-market boutique. For us, mid-market is 5 to 50 million. We've got offices in London and Henley. We were incredibly busy, actually, as soon as lockdown, unlike you, Nick, but I'm not sure how productive we were, because we really spent the first few months really just triaging all the transactions we're working on. A lot of those paused, a lot of them we had to rethink and went away, and a few we were able to complete.
Thanks. Thanks, Andrew. Much obliged. Adrian.
Yeah. Good afternoon, everybody, and yeah, delighted to be on the webinar with everybody. Yeah. So FRP, I'm corporate finance partner, and I live down in Sussex. You've probably seen FRP sort of well known in the restructuring market, actually, and we've been in the news significantly, particularly this week, with Debenhams and Prezzo and other big on the RS side. We do actually have a corporate finance part of our business and debt advisory and other things, as well as restructuring, and I'm partner in that side. And yeah, we're sort of lower mid market, again, pretty similar to Andrew, sort of 5 to 50 million corporate finance, assignments, up to possibly 100 million. Yeah, as I do what I say the good side, while my colleagues do the dark side. Although, as you can imagine, with a lot of accelerated M&A processes going on at the moment, our corporate finance team are helping and supporting the restructuring team on those transactions at the moment. But yeah, look forward to discussing those issues as we go through the rest of this presentation.
Thanks a lot, Adrian, for that. And Paul.
Hi, so my name is Paul Joyce. I lead the London M&A practice here at Mazars. We're a global M&A practice in over 50 countries, but in the UK we're about 70 strong, dotted across the country. We, much like Andrew, concentrate on the mid-market and lower mid-market, so 5 to 50 million pound transactions, but with a very much a bent on private equity and owner-managed businesses. So we spent a lot of time over lockdown looking at C-bills and working with private equity-backed businesses who are looking to potentially either look at cash flows or potentially look at opportunistic acquisitions. So yeah, looking forward to talking about the outlook for 2021.
Great, thanks very much, Paul, and again, thanks everyone. And so let's shoot into some of the questions now. To Andrew, what have you learned during 2020 that will impact how you approach M&A next year?
I think firstly, I've been around long enough to see a number of shocks to the economy over the years, and what's quite clear this one, it's not all the same. I mean, 2008 transactions really stopped when there was turmoil in the financial market, but this time around there is strength in the debt funds and the P markets, and transactions are happening. And I think for me the two lessons are that firstly, good businesses will transact at a full price, whatever the economy is doing. Yeah, we're seeing some quite frothy multiples on transactions at the moment. And secondly, I was always a slight skeptic that home working actually can be effective. I always thought it was something you did when you had a hangover, you had a washing machine that needed fixed. But this remote working, yeah, we have got it to work, and I think we're all questioning the amount of time we used to spend travelling.
Thanks very much, Andrew, for that. Paul, do you wish to add anything to that?
I think I'd echo Andrew's view that the previous crisis, was very much precipitated by a financial market crisis and a credit crunch, and this one's a much more humanitarian and healthcare crisis. And what it has meant alongside the fact that you have a much deeper capital pool, that transactions are definitely still going. And I'd agree, those businesses that have either been resilient to COVID, or indeed in a post-COVID world look even stronger, particularly e-commerce, healthcare, other technology businesses, those are ones that are going for really high multiples. And couldn't agree more that I can't see us going back to a world where we spend 5 days in the office. I'm here at the moment, and you realise that the time and the energy wasted in jumping on the train, especially in London, getting in and out of central London, is time you could be spent doing conference calls and speaking to clients and engaging in transactions. So I think we'll definitely enter there'll be a new normal in 2021. It'll be interesting to see how that unfolds. But yeah, I agree that we'll have learned a lot from 2020 for good and for bad.
Just to add, Mark, sorry, Mark, I was just going to add,
Sure.
I think what we found actually, to summarize that, is that deals can happen remotely. And buyers will buy businesses without potentially having even met sellers. We completed a transaction in beginning of October where I never met our client and I've never met the buyer. And everything was done remotely. Transactions can happen remotely. And I think if you'd have asked pretty much all of us probably before March, we'd have thought that was almost impossible. And actually going into the pandemic, that was probably my biggest concern, was not necessarily what's going to happen, but it's actually how is anyone going to appoint an advisor without having met them? How is anyone going to complete a deal without being able to physically meet? But I think we've proven this year that can happen, and that will probably continue to happen.
Yeah, no, thanks. Yeah, certainly the social and business and commuter impact of everything has been really interesting. And Adrian, how have you seen deal structures evolve during 2020?
Yeah, thank you, Mark. That's a very interesting question, and they certainly have. And I think we've seen definitely some differences appear as we've been through the summer. I guess when you're looking at deals and people are buying businesses, selling, it's all about the quality and sustainability of earnings, and never has that been so important. But of course, we've got a number of businesses that have done extremely well during COVID, and maybe had COVID spikes, and conversely, we've had businesses that are on the way on coming back, having had a dip. And clearly, if you want to transact a business at the moment, one has to sort of share the risk between the parties, potentially in those transactions, one way or the other. So I mean, largely prices have held up, and I think we'll come back to that sort of later. But so the risk has been dealt with not necessarily through price adjustment, but through more earn-outs. So we've seen certainly more an earn-out, and a component part of that earn-out may well be a sort of KPI driven earn-out, where cash is retained. It's a much shorter run on that, but as people come out of COVID or need to prove that they can sustain a new level of earnings, that the money will be released, maybe over 6, 9, 12, 15 months, relating to a sales target or customer retention or customer acquisition, whatever is the key metric in that business, rather than waiting for the usual 1-2 years heavy EBITDA based earnouts. And that may just bridge the gap. That might bridge the gap between the vendor's expectations and and managing the risk for the buyer.
Yeah, no, very, very interesting. And Nick, is there anything you would like to add to that?
No, I completely agree with what Adrian said. I think we're definitely seeing buyers wanting to take less risk up front because of the uncertain economic environment, and whether that's through earnout structures or, we had a deal earlier in the year where the buyer kind of said, actually, we're not going to buy, we're going to invest at this stage, but we'll have an option to buy down the line, just kind of managing their risk. So in terms of deal structures, it's more less risk for the buyer and kind of more potentially on the seller, but valuations kind of similar levels on those deals. We have probably seen more diligence being done because of the uncertainty in the environment, more reliance on warranties and things like that in terms of deal structure. So more emphasis on warranties and lower caps potentially like that. Just again, buyers trying to manage their risk. But I think that will continue in 2021. And I think that it's probably here to stay for a while. And actually generally deals taking longer because people spending more time doing diligence, and every decision is in an uncertain world, needs to have more scrutiny, really, from especially in private equity world with investment committees, scrutinizing deals on a regular basis.
Just one other area we've seen potentially coming in is with possibly more mergers with no cash changing hands, because that manages the risk. So you might have competitors have been competing against each other, reducing margins, and they might feel better together. One of the management teams is younger, stays on, runs the business, and the vendor gets out, keeping a stake in the business, but no cash changing hands. So that would help manage risk. And there's been some sort of evidence that may be a structure that's useful going forward.
Yeah.
But probably consistent with that is the fact that the high street banks have lost appetite to put debt into transactions. So it's not only managing risk, but actually the availability of capital from the high street banks to fund transactions. It just adds another element of execution risk for the acquirer.
Thanks. Thanks for all of that and all your comments here. And I think we rarely do a webinar where we haven't got some tax-based question, and this one's no different. And so, Paul, how do you think the potential changes to capital gains tax will impact the M&A market?
Well, I think working so much with the owner-managed part of the market, this is a huge issue for people, because I think there is general consensus that capital gains tax will change. I think there's quite a lot of consensus that it's going to increase, but there's a lot of uncertainty about exactly how that's going to look, what concessions there might be for entrepreneurs, how that might look, when it's going to come into force, and what transactions it's going to capture. Is it going to be from the date at which the laws change, or is it going to be backdated? So it creates a lot of uncertainty. I think if you're a business that is thinking about selling, or was thinking about selling over the last few months, it's definitely accelerated a number of people's plans, and people have been putting in motion transactions, whether that be full exits or partial exits, to try to realize some capital at a potentially lower tax rate. And we've seen quite a few people speaking to us either about bringing in external equity investment or using debt to enable a capital buyback to lock in that 20% tax rate. I think what is going to be interesting is that if you haven't started that process now, it's going to be pretty challenging to get it done by March or April, whenever an announcement's made. So I think that if you haven't started thinking about it now, you're running pretty short on time. And I think that there are other options available, and it might be debt-led. Those tend to be slightly quicker transactions. I think what will be interesting is straight after the announcement's made, because I think if there is a significant move and it comes in with effect immediately, I think there are going to be quite a few people reassessing whether now's the right time to exit their business. So I think post-April, we might well see a reduction in the number of transactions, but I think it really depends on what Rishi Sunak says when he gets up and presents his budget. But I think all that uncertainty just creates a lot of nervousness and a lot of uncertainty in business.
Yeah. Thanks for that. Andrew, is there anything that you would like to add to that?
Yeah, I just echo that. I mean, I think we're all busy now. There's a bit of a rush to the door at the moment. I suspect the outcome of that will be there won't be many businesses coming to market Q1 next year. And just one other observation, and a regular conversation piece now with guys is employee-owned trust. I wonder if those will come into fruition a lot more, which is where you can, in short, sell a 50% plus shareholding in your business to a trust owned by the employees, which is capital gains exempt. That's been around for a number of years. A lot of people didn't go through that hoop because they're only saving 10 to 20% tax. If it's 45, I think we'll see a lot more of those.
Okay, thanks for your comment there, Andrew. And now we come to the sort of ever-looming Brexit issue, which is never far away right now. And Nick, I'm afraid I'm picking on you for this one. So what do you think the impact of Brexit might have, excuse me, on the M&A market next year?
It's interesting, and the honest answer is I've got no idea, and I don't think anybody does. But based on obviously Brexit's been in the pipeline for a few years now, and interestingly, every time there was a potential deadline for Brexit in our world, we seem to see things quieten up. So when the deadline was potentially March, the February-March time, we're always a bit quieter, people are a bit more uncertain, and then as soon as the deadline got pushed, deal activity sort of ramped up again. What's interesting is that, and that kind of happened pre-election last year as well, we saw quite a seismic kind of downturn for the period of sort of 6 to 8 weeks before then uncertainty and everything sort of ramped up again. I think everyone's Brexit sort of gone on the back burner this year because of COVID and because of the pandemic. And on that basis, it's very difficult to know. I mean, we haven't actually seen the opposite of a downturn, even though we're kind of coming towards a potential no deal date and we don't know what's going to happen. And we're still waiting to hear. I think it depends on the sector really as to what impact Brexit will have, and it depends on the nature of the business. I think if there's a lot of kind of cross-border transactions, people need to get into place activity, and I think that buyers will account for that when they're thinking about future performance of the business and potential extra cost that it involves. I think the challenge is people don't really know what it means yet, and they don't really know how they're going to account for it. We keep being told to prepare for a no-deal Brexit, but even a no-deal Brexit, we don't necessarily know what that means. So I think that what we've seen over the last couple of years is, some special provisions put from buyers in the SPAs around Brexit terms, and where we have split exchange and completion kind of Brexit deal, whether there's a deal or a no deal, being what we call material adverse change clauses in there relating specifically to Brexit. We've seen more extensive diligence again, and same with COVID, we're seeing more extensive diligence over the last few years because of the uncertainty around Brexit and making sure buyers are kind of looking into those potential risks a bit more. So the honest answer is I don't really know what the impact Brexit will have on the M&A market. I don't think anybody really does. I don't think it's going to have as a material impact as capital gains changes or obviously what's happened with COVID this year. But I think, again, it depends on the nature and the sector of the business, and it's one that buyers are still obviously looking out for, albeit I don't think it's as big an issue as it potentially could have been or would have been had it not been for COVID.
Yeah, thanks for that, Nick. I know it's not an easy area. And Adrian, is there anything you'd like to add to that?
No, I think I'll just echo what Nick said. I think in the context of probably a net GDP decrease this year, wasn't it, forecast 10 or 11%, and I think Brexit was no deal Brexit was forecasting sort of 1 or 2% or something. It's probably now become insignificant compared to the COVID effect. So what bit that worries me, I think, going forward, I think even with a deal, I think not sure all companies or everybody realises that quite a lot of changes are going to be made anyway. And having worked, I'll do some strategic advice to a company that brings in 7 or 8 lorry loads a day through the ports and everything, and a lot of the paperwork and things have changed anyway, and would still. It's just about whether there's duty there. So, as you say, the knock-on effect, and have people considered that, and how does that impact on deals and the due diligence, as Nick said. So those businesses, the supply chain. I think the supply chain in from Europe, clearly it's been well flagged. The just-in-time approach, and probably more only again, DD sort of a linked point really is the impact of supply chain, into China and that sort of thing, which I'm not sure we're going to touch on what companies are doing there, all the impact in the global markets, and it's not just about Europe. So, there's a lot of due diligence into supply chains. If you're completely reliant on China, and that deteriorates and you can't get your product in, that's going to have a major impact on deals, and that could still be bigger than Brexit.
Yeah, no, thanks for that. Thanks for braving those Brexit waters, as it were. And a fairly to the point question, Andrew, is now a good time to make acquisitions?
Right, I mean, you're asking people to make their money by doing acquisitions. The answer is yes, of course. I mean, yes, I think it is. In short, I think there's a number of businesses with a number of challenges, and consolidation is one way of dealing with those challenges. I do think you need to be aware of bargains. I think there's a lot of rubbish out there in the market, and I think with the good transactions, I think you've got to pay full price at the moment. Priority is competing for deals, paying full price. I've got something completing today, 12 times EBITDA. I wouldn't have expected that price 12 months ago. And I think the debt market, it's a good debt market as well. It's a good time to raise money. So be it debt or private equity. I think the high street has largely disappeared as an option for funding transactions, but the debt funds have stepped in.
Oh, thanks, Andrew, for that insight. Paul, anything you'd like to add there?
Yeah, I think I'd only say that there's making sure you understand the difference between price and value. I think you can get cheap deals, but they might not be good value deals. So diligence at the moment is really important. It's understanding if businesses are struggling, whether that's a fundamental challenge with their operating model in the market to which they serve, or whether it's a capital structure issue that actually potentially a new buyer can come in and unlock. And Andrew's absolutely right. Consolidation in this type of environment, with the economies of scale and the infrastructure that brings you, can be very attractive. And we're seeing a lot of private equity houses put more capital towards bolt-on acquisitions, because I think they see a lower risk in acquiring and backing existing management teams and potentially going out and backing completely new businesses. But I think if you can find the right opportunities and you can be bold and you've got a strong balance sheet, I think now is a great time to be looking at acquisitions and growing the business.
I just add, I think with the danger is an acquisition can destroy value as quickly as it can grow it as well. So just because it's opportunistic and it's a distressed business, a lot of management teams don't have the bandwidth or the skill to do a turnaround. So you might want to do acquisitions, but don't just look at the one that's in front of you. Do a sort of proactive search, look at the whole market of the targets, and then get someone to, and then go and have a chat with those other companies, and that might even build you better value. You might have to pay a bit more, but that might be a better value deal for you.
The other thing I'd just add is that actually, in terms of thinking about sellers, especially if it's a kind of small private business owners, entrepreneurs, a lot of people that we've spoken to, and especially in the last sort of 6 to 9 months, actually this pandemic has sort of taken out of them. And whereas they probably weren't considering a sale for 4 or 5 years, actually, do you know what? I'm happy to sell now. I just want to get out. I can't be dealing with this anymore. And actually, probably price expectations have probably come down as well. And therefore, if I'm a buyer, I want to make the most of that and take advantage of potentially some people that may not have been on the market as such now than they would have been kind of a few years down the line. The flip side is there's obviously some sellers who think, actually, if my business has been impacted by COVID, actually I don't want to sell for 2 to 3 years, subject to kind of capital gains tax changes, but I don't want to sell for 2 to 3 years where I was considering something in the short term, because I think if I sell now, I won't get as much value as I potentially would have done in 2 to 3 years. So there's the pros and cons of that, but I definitely think there are business owners out there that potentially weren't considering a sale that now are, and therefore it's an opportunity for buyers to make the most of that.
Yeah, no, thanks for that. And that sort of leads quite nicely on to Adrian, if I can ask you, what would your advice be to owner managers who might be thinking of selling next year?
Yeah, I think that's a $6 million question, isn't it? I mean, I think advice. Tony Blair says education. But I think it absolutely paramount now getting that advice from somebody who knows the market, knows what they're doing. I think taking a holistic view of your affairs, if you're an owner manager, not just look at the value of your business, but consider what you actually need when you sell from the business. Looking at capital sum, you've had probably some series of bad advice, potentially value erosion in your business, potentially your personal assets have dropped, and third piece of tax regimes changed already. So actually having a proper assessment of what your pensions are worth, what your assets are worth, and how much you actually need when you retire, and get that advice, and having a realistic view of the price of your business and what that deal structure might like. I mean, I've been selling businesses for over 30 years, and I think I've only twice had to tell somebody their business was worth more than they thought it was. So there's always, price expectations of vendors all seem to be, higher than the reality. So you need good advice from, guys like who are on this call, and and you might just want to think about doing it, maybe not going completely out to the market. You might go and test the market, especially if you're in a sector which is not one of the ones that are running hot at the moment. But yeah, key thing is but actually just write yourself a strategic exit plan that sits alongside your business operational plan as well, and just see how that fits together, and just engage with advisors early in that process, and then they can track the best time, to make the dive into the market next year. And then maybe it's not appropriate next year, and maybe it's down the track.
Thanks, Adrian, for that. Nick, is there anything you'd like to add to that?
No, I completely agree with what Adrian said. I think, the key thing, regardless of when you're thinking to sell it, if you're thinking to sell in the next 5 years, is start planning for it now. And as Adrian said, the exit plan is important, making sure that you've got no skeletons in the closet. As I said before, due diligence is becoming more and more intense. So you want to make sure that you've got a clean bill of health when it comes to a DD exercise, regardless of whether it's a trade buyer or a private equity buyer. Get that planning done early as possible, but also strategic planning. So when you present a business to buyers, you want to present it with credible growth opportunities. So it's all well and good saying I'm going to grow my business, but actually buyers have got to believe in that growth. So you've got to have credibility to it. And sometimes it takes 6 to 12 months or even longer to build that credibility. So start thinking about it, start planning it now, getting that exit plan, as Adrian said, absolutely critical. And it's never too early in our world to start that planning piece.
Thanks, Nick. And Paul, coming to you on the subject of sectors, really, and specifically, leisure and travel, for instance, how will that be impacted, do you think, from an M&A perspective, when things perhaps start to normalise a little?
Yeah, it's a really interesting question, and the biggest uncertainty probably about that question is what's the new normal going to look like? And I think there's a huge amount of uncertainty about how much global travel and local travel there will be in 6, 12, 18, 24 months time. Andrew hit the nail on the head there about right at the beginning talking about working from home, and I think working practices will change materially, and I think we'll see people question the use of travel where things can be done electronically. People will obviously still want to go on holiday, and there may well be some pent-up demand from people who've been unable to leave the country from personal reasons over the last sort of 12 months. So I think it really is going to be a huge question about what the new level of activity, what the new level of demand from a services perspective looks like in the leisure and travel industry. I think what is going to be clear is there'll be some people who won't make it through the crisis, and there'll be some people who do. And I think those that do will be in a strong position to be able to take advantage of whatever the new normal looks like. But there's going to have to be a reassessment and resetting of what levels of demand are, what operating structures and capital structures look like, to make sure that those businesses that were efficient and primed for the previous normal are also primed for whatever the new normal looks like. And there'll be winners from that. So, I suspect there'll be more niche businesses in travel and leisure that take advantages of some new trends that come out of a post-COVID world. And I think some of the traditional players will be looking at either consolidating their position or getting into some of those niche areas. So I think from an M&A perspective, we will see some distressed M&A in the short term, and we'll probably see some more strategic M&A in the longer term. But I think people who run those businesses are going to have to think very carefully about what demand looks like, what a fit for purpose business looks like, and then part of that will be achieved through capital and restructuring change internally, and some of it will be achieved through M&A.
Thanks, Paul. And Andrew, anything you'd like to add there?
Yeah, I think you've got to think about this, the attractiveness, availability of funding for this sector as well. I mean, really over the last 10 years, we've seen a gradual shift of institutional money being attracted towards B2B businesses that are tech-enabled. I just think we've seen a massive acceleration of that. And I just think from an A point of view, I don't think it's great news for travel and leisure. I think if those businesses aren't future proofed, I don't know how you do it with some of those. If there's not real, if they're not got some techno future proofing, I just think a lot of them just won't be transactable at any price. And we're not going to see deal activity in that sector return to the levels it's been historically.
Yeah, thanks, Andrew. Just to add, by the way, to anyone that may have come in after we started, do put any questions in the chat box. Don't email them, as I think Zoom perhaps asks you to, but do put any questions in the chat box, and we'll try and get round to a few of those towards the end of the webinar. So feel free, anytime, just to stick them in there, and I'll get back to them towards the end of the webinar. So moving on, Nick, what's your view on how valuations will be affected, and impacted over the next year?
Again, it's an interesting question, and again, it depends on what sector a business operates in. Clearly, if you're in, as Paul and Andrew were just saying, if you're in leisure and hospitality and travel, you've probably not had a particularly good year from a trading perspective, and therefore valuations are going to be lower, and you're going to be seen as more distressed. If you're in, technology potentially, or medical devices or anything like that has potentially traded quite well, then valuations are different. So it does depend on the sector. I think generally what we've seen is actually valuations haven't been as impacted as I potentially thought they would be this year. As we said before, deal structures may have changed with a little less cash up front and more based on future performance. I think generally, as businesses can prove that they're back to pre-COVID levels, or even beyond pre-COVID levels, actually valuations potentially increase rather than decrease going forwards. I think if you can prove that you've traded through one of the biggest global pandemic of our lifetimes, if you can trade through that pretty well and prove that you've got a trajectory back to kind of pre-levels or even beyond, actually valuations are potentially going to go up, because there'll be a lot of businesses that can't do that, and therefore that makes you more attractive to buyers, as buyers have less options. So I think generally across the board, valuations, okay, it says before, it depends on the sector, but generally I think there's opportunities for valuations to be higher than they were before, but it very much depends on your performance of your business and the sector that you're in. Yeah,
well, thanks, Nick. And Adrian, anything you'd like to add also?
Yeah, no, I'd reiterate that. I mean, I think this is sector driven. I mean, clearly, if you're in a sector, data driven businesses, SaaS businesses, healthcare, and the businesses, particularly the private equity market, determine a safe bet. I think there's a lot of them chasing quite a few sort of less assets on that, so that's driving price. And we've heard some pretty racy multiples being paid in the market. So I guess if you're sitting as a vendor in one of those sectors, now is a good time to really consider getting on the market while that position is in the market before it levels out again. But so I think it's sector driven. Businesses like logistics, last mile businesses, that sort of thing, anything that's benefited from COVID, clearly there's a imperative to push the price up. But I think generally for a smaller owner managed businesses, actually over the years valuations don't really change that much, truth be told. The lower end seems to be quite a narrowish range of multiples. So I mean, it'd be interesting to see how it unfolds next year. And I think we made a point earlier, it's about how you present your business, and if you've got a good strong business, with good strong earnings, sustainable, and you can prove it, that will drive the value.
Thanks, Adrian. And Andrew, on the sort of subject of distressed M&A, do you think there'll be more distressed M&A in 2021?
Yeah, I mean, I don't do distressed M&A as such, and I think that there's clearly lots of distressed businesses at the moment. I mean, that won't entirely translate into more distressed M&A, because I think a lot of these will just not be transactable. But I think logically that there must be in some of those will. So I think there will be an uptick in distressed M&A. But I say not exponentially in the same way that we've got a large increase in number of distressed businesses. And we talked about travel and hospitality recently. That it's going to be a brave man that actually acquires some of those businesses and does what. So a lot of these will just unfortunately fail. and not be part of the process.
Yeah, thanks, Andrew. And Paul, would you like to add anything there?
Yeah, I mean, I think that's right. That we expected a big uptick in restructuring and distressed M&A over the summer, and the government has done a very good job of postponing that with some temporary measures. I think there's definitely going to be another run of this as the measures begin to unwind, and you probably have some businesses that were unsustainable, maybe even pre-COVID, and certainly post-COVID, but have been able to access lending or furloughing of staff, and that's kept them in a slightly zombie state. But as soon as the world reopens and those subsidies begin to turn away and the holidays on tax repayments and the like begin to expire, I think we could see another wave of that. But Andrew's absolutely right. I think you still require a business that has value to somebody for there to be an M&A transaction. It has to be a willing buyer and a willing seller, and if the business is just not sustainable going forward, there isn't going to, or is very unlikely to be, a willing buyer at a sensible price or even at all. So I think we will see more distressed M&A, but I think you have to be very careful if you're an acquirer of that type of asset, that you really understand why it is the business has struggled, and you have a clear plan to be able to turn that around, and that your diligence, as Nick has pointed out, is really focused and understands exactly what you're buying. Because there is nothing worse from a value perspective than paying for something that doesn't have value and then finding a huge job to try to turn it around and failing. That's not great use of capital resources.
Yeah, and on that point, people can say, "Oh, I can get a bargain, I can buy something for nothing." But if you're buying something for nothing that's going to have losses for the next year, you've got to fund those losses for the next year. So it's not nothing. You've got to pay a lot of money for it. So that's the other thing to factor in as well.
And the time and the engineer management. Yeah, and there's a lot of time and resource and management energy that goes into that turnaround process. As Adrian said, not everyone has that skill to be able to turn business around. So you're right, there is a financial and non-financial cost to these acquisitions, even if the price is, or the enterprise value is zero.
Yeah, well, what you really want is just it's a distressed seller, not a distressed business that you're acquiring. That's where the real opportunities will be.
Yeah, some very interesting points there, and that latter one, Andrew. Onto the banking market, which again is always interesting to see how they're reacting. But Adrian, do you think the banks will continue to fund transactions in next year?
Yeah, I mean, I think and I'm not sure how it's been a bit variable through the summer. Obviously, they've spent the first part of the summer dealing with their existing customers and being extremely busy to supporting their customers through all the CBOR loans and everything. So, and a lot of them have been sort of fairly nervous about new to bank funding. So where that involves M&A, I guess in the sectors that are doing well, we mentioned earlier that the banks will support their portfolio clients with acquisitions. New to bank is more of a challenge, although I think quite a few of them are now saying they are open to look at new business, but I think it has to go quite a way up the line in terms of approval process and credit approval before they can look at those. The interesting thing is the secondary market, the next tier down. I think they're looking at the opportunity to take some business from the main banks, and have probably got more of an appetite, and I would guess that would continue through next year. And then you've got all the alternative debt suppliers that you can talk to, the debt funders, and there's a plethora of those around, and there's some good debt advisors around, and we have our own debt advisory team that can help source debt. But yeah, I mean, you probably do if you're with a bank and they're prepared to support you. Clearly, that's the easy. Stay with them; they know you. That's going to be the easier play. But obviously, if you can't fund something with the existing bank, there are other alternatives.
Yeah, thanks, Adrian, for all of those comments. And Nick, would you like to sort of add anything there?
I don't really have anything further to add. I think I completely agree with what Adrian said, and what Andrew said earlier is, high street banks have been, doing their own kind of coronavirus business interruption loans schemes this year. and actually less interested in funding transactions. But the alternative funding market is absolutely grown, and we're seeing a lot more traction from that in both private equity deals and actually growth capital as well. So it's the alternative, and it's not necessarily just kind of traditional term loans. It's alternative sources of funding through. We're seeing more around things like invoice financing and stock financing, all different types of funding, merchant cash advances. We're seeing, and because more and more businesses than ever probably need cash and will need cash, as Paul says, when the government support stops. These alternative funding sources will come up. So I'm still confident there'll be a lot of funding available next year for sure. Yeah.
No, thanks, Nick. And the final question, certainly from our side, or before we come on to what I can see actually are some interesting questions coming through from some people there, which I'll come on to. And so on private equity, Paul, what do you think the PE's appetite is to invest? How is that likely to be next year?
I think that it's a really interesting private equity funding market. You've got a lot of funds that have raised new capital over the last 2 to 3 to 4 years. I think with the Brexit uncertainty for the last couple of years, there's probably been a slightly below expected deployment rate of that capital, and then we ran into COVID. So there's a lot of what people typically call dry powder in those funds, who are keen to put money to work. And whilst they're not going to invest in businesses that aren't going to generate the sort of returns they want, equally their investors expect them to deploy that capital and make returns in it, and just sitting on it doesn't achieve that. So I think there is going to be a demand from private equity to deploy capital, but these are smart people. They're not going to invest in businesses they don't see a strong return in. They're going to want to do their diligence, as Nick said, and they're going to make sure that the businesses they're investing in are high quality businesses. But I particularly given that we've got this strong debt funding market from the alternative lenders, I think we're not going to see the same drop off in private equity investment that we saw post the credit crunch, where the lack of debt made it very difficult for them to invest and make the returns without the leverage. So, I definitely think there will be quite a bit of activity, both new platform deals and private equity businesses looking to, bolt on and expand existing investments. So I don't expect to see too much, let up in terms of investment rate. And in fact, if anything, as we come out of lockdown, I suspect that some of these funds will be behind on their investment curve and will want to be deploying more capital over the next 2 to 3 years.
Thanks a lot, Paul, for that. Andrew, what's your comment on that?
Yeah, I completely agree with what Paul said there. I guess one word, I think our appetite would just be insatiable. And I guess any slight word of warning, I think private equity, I think they're very comfortable paying full prices for good businesses at the moment, but they are going to be picky on what ones they invest in. But I think those they find attractive, and it's the features we talked before. It's tech-enabled B2B businesses, particularly if they've got a sort of buy and build platform opportunity there. Then there'll be plenty of private equity money chasing those sorts of transactions.
Yeah,
I think it'd be very interesting to see if capital gains tax does increase up to sort of income tax levels, and it means there is a slowdown in sellers, entrepreneurs looking to sell, business owners looking to sell their business, what impact that will have on the private equity market. Because as Paul said, there is a lot of dry powder and they've got a lot of money to spend. And actually, if there's less sellers out there because of the tax changes, less incentive for sellers to sell, what impact will that have on private equity? Will it mean they have to pay more for these businesses because they've got to spend the money? And then what does that mean for kind of the sort of the more upper mid market or kind of larger private equity funds who do the secondary buyouts? And what will that have kind of a knock-on impact down the line? We just don't know yet because we don't know what the potential tax changes are going to be. But it would be very interesting to see what impact that does have on PE.
Potentially, if you've got the CGT goes up from 20%, ignoring the release, to 40%, I guess you're going to have to pay that extra to persuade someone to buy, aren't you? To compensate for the CGT to get them back into the same position.
Yeah, I think longer term price expectations will align, but short term, that big hike in CGT, people just aren't going to take their business to market, are they? Until they get a very full price.
Yeah, and with the slowdown in, you know, with Brexit, and then with COVID, and as Paul says, with their dry powder and kind of less active in the last few years, you know, these guys have got a fund with a specific time limit, and you know, if they've raised their fund 5-6 years ago and they haven't necessarily invested, or even less, and they haven't necessarily invested, then what impact will that have? It'll be just very interesting to see, I think.
Yeah, and look, to my mind, I think the smart thing to do in terms of what they're trying to really address with the CGT reform would actually be to align the income tax rate, align it with income tax rates, but then reintroduce entrepreneurs relief at 10 million.
Yeah,
because it's not really those aren't the guys they're trying to tag.
Well, I was about to say that term entrepreneur and the relief for those entrepreneurs has been sort of expanded and encompass people who aren't, as you say, genuine entrepreneurs who have built up businesses. You know, I suspect most of the people on this call are people who started their own business, built it up, and those are exactly the people that the government is trying to give relief to and trying to encourage, not necessarily the professional investment community.
Yeah.
There's some word that they might start rewarding longer term ownership. So going back to those who are old enough to remember things like retirement relief and taper relief, albeit at lower limits, you had to hold businesses for longer to get the benefit of those capital gains tax reliefs. So there might be a return to that sort of model.
And there was an age thing as well, wasn't there? If you go back years and years, retirement relief at 50 years old.
Okay, well, thanks again for that, and thanks for running through a whole spectrum of questions that we kind of just fired at you, and some really interesting and great points there. So thanks again. Are we coming to the sort of closing phase of the webinar? I'm going to move on to some questions that have been posted on the chat, and please do just stick your hand up if you would like to answer or make a comment on this. So from Rupert's, and thanks Rupert, you've asked what's the panel's view on the impact of the National Security and Investment Bill on the M&A market? Would anyone like to venture on that one?
I could take that bit if you like, or
yeah, please do.
Yeah, so I mean, for those people who might not know what that is, that's a new bill that was put before Parliament on 11th of November. I think they helpfully released the consultation paper at the same time, so I think it's something the government kind of trying to slip through. And it has an impact on. It's supposed to stop overseas buyers buying sensitive assets in the UK, but they've very helpfully widened it out. So I think 17 sectors. There's no de minimis size limit on what businesses could be affected, and it embraces sort of not what you would necessarily call what you would think of as national security risk assets, but it can actually wrap in things like any business that's got any sort of IP or data or anything that would be deemed sensitive to the national interest can be called in, and it potentially impacts all overseas buyers. It potentially impacts private equity companies that might have overseas investors in them, which could be interesting. And the onus is you have to get there's a clearance process. You have to get clearance to do a transaction with an overseas buyer. I think my understanding is the onus is on the buyer to do that. And I think the consultation paper suggested it could impact sort of 1,000 to 1,800 transactions a year. Rather helpfully, I'm not sure the process for actual review is actually fully in place yet. So, and actually they can call in any transaction that's happened since the 11th of November when the bill was put before Parliament. So it could have an impact. Series could have a big impact depending on how it unfolds and how efficient the process is. It could delay deals, it could stop deals. I think it's all trying to stop various overseas countries sort of investing. They want to stop certain ones, but the government didn't want to name the ones they didn't want to invest. So they've brought this bill in. So I think it could have quite wide-reaching impact on that. So thank you for that question, Rupert. I'm sure you enjoyed getting that one.
Yeah, very, very informative answer there, Adrian. Thanks very much. And Ian has asked, and also thanks to Ian, will the office facility sector be next to follow the woes of the high street? Would anyone like to take that question on? Paul, yeah.
I'll have a go at that one. Look, I think it's really clear that I think it's really clear that the way that we're living our lives, whether it's how we shop or how we go to work, is going to be different going forward. I think there is the move from people shopping on the high street to online retailers, and the move from people spending the amount of time in the office that they would have done historically, going forward, I think is going to change. Whether that is 20%, 50%, or 80% is sort of yet to be seen. But I can't see how there is not going to be a shift in the supply-demand dynamic for office space going forward. I think there is going to be some consideration about how people use the office, so that there might not be as large a reduction in the amount of office space people use compared to the number of people that come into the office. There might just be reconfigurations of existing office space, but I think there's definitely going to be a change in the way that's used and probably an overall reduction. So I suspect that if you're looking for office space at the moment or thinking about your office options, I think you've got quite a lot of leverage and quite a lot of power, and I think that's only going to increase over the next sort of 12, 18, 24 months. But I think that also then creates opportunities for, as the same way in retail, I think there will be losers like the likes of Debenhams with large retail footprints on the high street, but huge opportunities and upside for people like Amazon. I think the same will happen in the office space market, that the traditional large city centre office space will probably come under more pressure, but more flexible, dynamic office space I think will become more attractive. So not quite sure what that exactly look like, but there'll definitely be winners and losers. But I can't help but think there's going to be an overcapacity in the short term in terms of amount of space and amount of demand.
And if you look at commercial property prices versus residential over the last 20 years, it's just an acceleration, a very fast acceleration, is what's been happening anyway.
Yeah. Well, thanks a lot, Paul and Andrew, for that comment as well. So moving on to, we'll take the last question now before I close off. So just for a few minutes, and thank you to Uma for this one. If the buyer thinks their management can turn it around due to the changing business model, I better see if I've got this right. If the buyer thinks their management can turn it around due to the changing business model and their management, they will buy. Is that?
Yeah, I think that's kind of more of a statement than a question, but I agree. I think, as we were saying earlier, I think with any acquisition, whether distressed or not, whether it's a turnaround or not, you need to integrate the businesses and need to make sure you've got a management team capable of doing that, as we were saying earlier. And if any buyer thinks that their existing management can go in, can implement change, can strategically get it right, because there's a core good business there, even though it may be distressed and had a poor few periods, then yeah, absolutely, it's a no-brainer to buy. I guess there's other factors to think about though in terms of culture as well. Culture is quite a big one in M&A. We often see strategically two businesses can fit very well together, but if they've got very different cultures, it doesn't always work. So there's other things to think about other than just kind of strategic fit and whether management can do something. But yeah, in principle, the statement is correct, I believe.
I think that, just as a word of warning, that there's going to be a lot of businesses that are struggling. It's going to be explained by COVID, and these are probably fundamentally flawed businesses anyway. It is a great excuse. Business is struggling at the moment.
I think the
conversation earlier. Oh, sorry, Adrian.
No, I just said, we touched on it earlier, but I mean, the danger is that it's actually quite a difficult thing to buy a business, and the easy bit is actually the transaction. You can get a lot of support around that, but it's all about what happens afterwards and the integration, and it's not until you work with businesses who are actually very good at doing acquisitions you realise how poor some people are, or not very good at doing acquisitions. And so if you then throw in a distressed business into the mix there as well, and if you haven't got a proper plan, 100-day plan and a 6-month plan and a year plan to do that, it fits into your strategy. It could be it could really damage shareholder value. So I think as we said earlier, beware of the distressed business, to make sure you can actually turn it around.
Yeah. Well, thanks very much. And Uma's just said thanks to the panel for that. So I'd like to bring things to a close, and very much thank Andrew, Adrian, Nick, and Paul for their massive and very insightful contribution today. I'd also like to thank all of you, everyone for attending, and hope you got something out of it. Please do let us know any feedback today on your thoughts, any takeaways. I'm going to email you all a link to a post that I will put on LinkedIn, and where you can make any comments. Hopefully you'll interact on one way or another, and some way or another with FD Recruit in due course. And we'd love to see you on another webinar or anything else that we're running. So have a wonderful day. Thanks to everyone, the panel, and everyone for participating. Thank a lot. Bye.
Thank you.
Sure.
Pleasure. Bye.
Thanks very much.